Hello and welcome to another episode of Frugal Finance. My name is Matthew and today I want to talk about the difference between individual stocks and ETFs or groups of stocks. So before we get into the video, I just ask you to smash the like button below, subscribe, comment, share. Please, let's just get this video out there. I want to try and grow the channel, help more and more people get control of their money and understand finances. So without further ado, let's get into the video. So first of all, we'll talk about stocks. Now, stocks and shares in individual companies are pretty much what they say on the tin. So you buy a small share or percentage, if you like, of a company in return for that share growing in price, so capital appreciation, and or a share of dividends. Dividends are actually part of the profits that the company makes, so they are not guaranteed. However, they can be quite healthy. There's various websites out there, things like Simply Wall Street, which will allow you to review a company's profile and as to the likelihood of actually gaining money off of those stocks. Now, with individual stocks, you may invest in companies that you like or companies that you dislike or companies that perhaps you believe are going to grow or pay out a good dividend. You need to do quite a considerable amount of research before you start selecting your stocks. Now, apps like Freetrade, Trading 212 and so on, multiple ones, allow you to buy individual stocks. Sometimes the stocks are priced at maybe a few pounds or maybe as much as a few £100, and sometimes you can buy fractional shares. So what that is if you have £100 share, you can buy say 50% of it for £50. Then next month, when you've got more money to put into the market, you could buy another £50. And then that way you would own one share rather than half a share. Half a share gives you half the appreciation and half the dividend income as a general rule of thumb. So that's a kind of a summary of, if you like, of individual stocks. Now, the downside of individual stocks is obviously companies can lose considerable amounts of money sometimes. And the stock will go down. The CEO could say something crazy on Twitter. We all know who that might be. And the share price can fluctuate an awful lot. So it's much more risky. And obviously there is also the possibility that if that company goes into administration or is struck off, then you have lost all your funds. There are other things like fund buybacks, fund splits and things like that, which all affect your end profit. However, the pros are, generally speaking, that individual stocks, obviously you can get extremely good growth and good dividend income from them. If you take Tesla, for example, rewind a few years ago, the stock was trading at about probably under £100, and now it's trading at around about £500 to £600, depending on the time of this sort of video. So you can see that's quite a big growth just on your initial investment. Obviously they're not paying a dividend at the moment, but that may change in the future. So you have to really do your research, not to get burned, if you like, but the rewards are quite great for those who will spend their time doing that research. So ETFs, or pots of shares, if you like, we could call them. I always find ETF is not exchange fund trading or something along those lines. I'll look that up if unless you want to comment below and correct me. But essentially what ETFs are is they are a pool of stocks which you buy into. So if a good example was given to me actually, where if you think if I owned 100 houses and I said you can buy a 10% share in one house and you get 10% of the rent, 10% of the appreciation. If the tenant stops paying the rent, then obviously you would dip out in terms of your returns. However, if I offered you 1% across my whole portfolio, the chances of you ever dipping out because of one tenant not paying rent would be immaterial. It wouldn't matter against the whole portfolio. So you're spreading your risk a lot further. So a good example of an ETF is the S&P 500. It's generally speaking one of the sort of benchmark ETFs that you can purchase into. So that is the top 500 companies in America. Now, if say number 368 went into administration, went bust, what would happen is some other company would replace that at the bottom of the list probably, and the 500 companies remain the 500 companies. The chances of less than 500 companies ever being in existence is probably, the variables on calculating that are almost impossible. So it's a relatively safe stock. The downside with these stocks is that you have to actually look into what's in the stock. So they are groups of stocks all bounded together or pulled together into one. And they can be quite heavily weighted. If, for example, you look at the S&P 500, you'll see that the top 5 or 6 companies make up quite a large percentage of the income in the whole S&P 500. So there's an acronym, FANAM, or I think that's how you pronounce it, but basically it's Facebook, Microsoft, Apple, Google, Tesla will be joining that at some point, I'm sure. So those companies make up a massive percentage of the profits of the S&P 500. All the other companies are either breaking even, some of them might be losing money, or they're not contributing to it. So the S&P 500 might not be as safe as people perceive it to be, but in reality it's probably safer than putting all your money into one company. So let's say Tesla's share price crashed back down to its £100 that we've referred to previously, you would have lost all your gains. If that happens and you're in the S&P 500, obviously it's a percentage of that loss because you've got all the other 500 companies contributing to your end profit, if you like. They are long-term gains. It is a case of buy and hold, and even through the dips, try not to sell. Obviously, this is an educational video, so you need to do your own research. I can't take responsibility for you if you put all your money into Tesla and it crashes. Don't come crying to me. You need to do your own research. You need to figure out your risk appetite and really plan around that. But generally speaking, buy and hold strategy for ETFs especially is probably a long-term strategy that will do most people quite proud. There is lots of research on the internet, which you feel free to Google and search up, that shows that generally speaking, most ETFs and pooled together portfolios perform relatively well over a long period of time. You need to be looking at keeping your money in there for 5 to 10 years minimum, really. On those kind of risk levels. So I hope that assists everybody in the explanation between an individual stock and an ETF. And if you like the video, please do subscribe, hit the like button below. I'll do more videos on various things, so please feel free to have a look at the back catalogue. There's a few links in the descriptions below. Until next time, stay safe and don't forget to subscribe.